It almost happened on a normal weekday. No alarms, no sirens, no breaking news banner screaming global economy offline. Just a quiet moment when money stopped trusting money. If you were awake that day, you probably didn't notice. Your phone still worked. Stores were still open. Markets were still flashing numbers. But behind the screens, something fundamental cracked. For a few hours, the global financial system, the thing that moves food, fuel, salaries, hospitals, came dangerously close to freezing. Not slowing down, stopping. And the most unsettling part? It didn't break because of greed. Or fraud. Or a villain. It broke because everyone did the rational thing at the same time. That day matters right now. Because the system that almost failed is the same one we're still using. With more debt, more speed, and less margin for error. Let's rewind. Money at the global level doesn't move the way most people imagine. It's not cash in trucks. It's not gold in vaults. It's promises. Banks promise other banks they'll pay tomorrow. Funds promise liquidity on demand. Governments promise bonds are safe. And everyone promises that someone else will be there when they need cash. Most days, those promises cancel out nicely. Then came March 2020. The world didn't shut down all at once. First, flights slowed. Then factories paused. Then offices emptied. But the real shock wasn't the virus. It was uncertainty. Uncertainty is toxic to finance. Nobody knew how bad it would get. Nobody knew which businesses would survive. Nobody knew who would default. And in finance, not knowing is worse than bad news. So institutions did the safest thing possible. They reached for cash. Not profits. Not yield. Cash. Pension funds sold bonds. Hedge funds sold equities. Corporations drew down credit lines, just in case. Banks hoarded reserves. Everyone wanted liquidity at the same time. And suddenly, the most liquid market on earth started acting illiquid. US Treasury bonds. These are supposed to be untouchable. The bedrock. The thing you sell when everything else is on fire. But in March 2020, even Treasury stopped trading smoothly. Prices gapped. Spreads exploded. Buyers vanished. It was like watching the floorboards of the system creak. Here's why that's terrifying. Treasuries aren't just investments. They're collateral. They're the grease that allows trillions of dollars in daily transactions to happen through something called the repo market. When the plumbing fails, the building doesn't collapse slowly. It locks up instantly. Repo is simple in theory. One institution lends cash overnight. Another institution posts treasuries as collateral. Tomorrow, the deal unwinds. It's how banks fund themselves. It's how dealers make markets. It's how the financial heart keeps beating. In March 2020, that heart skipped. Dealers hit balance sheet limits. Banks pulled back. Repo rates spiked. For the first time in decades, institutions weren't sure they could turn treasuries into cash on demand. That's the moment everything almost stopped. Because when collateral doesn't work, trust evaporates. And when trust evaporates, no one wants to be the next domino. Here's the uncomfortable math. Modern finance is built on leverage layered on top of leverage. A hedge fund borrows against bonds. Those bonds are financed through repo. That repo leans on bank balance sheets. Those banks rely on short-term funding. If one layer freezes, pressure shoots upward instantly. In March 2020, margin calls cascaded. Funds sold what they could, not what they wanted to. The safest assets caused the most stress. The system didn't break loudly. It almost failed quietly. While headlines focused on lockdowns, policymakers watched the plumbing fail in real time. And then came the intervention. The Federal Reserve didn't hesitate. They didn't just cut rates. They didn't just issue guidance. They became the buyer of last resort for almost everything. Treasuries, mortgage bonds, corporate bonds, even bond ETFs. Trillions appeared on balance sheets in weeks. Liquidity returned. Markets stabilized. The global economy didn't stop. But notice what saved it. Not resilience. Not excess strength. A backstop. And backstops change behavior. More debt feels acceptable. More leverage feels normal. More fragility gets ignored. Because everyone assumes the same thing. Someone will step in. Until one day the cost of stepping in is too high. Or the intervention itself becomes the risk. The day the global economy almost stopped didn't look dramatic. No crash button. No countdown. No single moment to remember. Just a realization among insiders that the system only works while trust holds. And trust, once questioned, doesn't recover quietly. So here's the unresolved question. If the global economy now survives by constant intervention, what happens the day intervention stops being a solution?